Wonderful, wonderful. So, as always, good afternoon, everybody. Thank you so much for joining today's session of our monthly Astor GlassDoor Portfolio Review. As many of you know, my name is Laura Nieves. I'm head of investor relations at Astor Realty Capital. I'm thrilled to see a full house here today, as always. Obviously, of course, we are thinking of our valued investors in both Florida and North Carolina over the last couple and the coming few days. We're sending you our thoughts and our prayers. So as we jump in today, oh, excuse me 1 second, let me just mute there. Sorry about that. Okay, so jumping in today, as many of you know, transparency is one of the core values here at Astor, and we're thrilled to do this monthly session that provides our investors a clear, comprehensive look into our current real estate portfolio and also gives you the insights into how Astor is on a daily, weekly, and monthly basis always working with new and current market conditions, how we're changing our approach, and how we work with those conditions to ensure that you guys, our investors, are being presented with safe and secure future investment opportunities, and also how we manage our current portfolio with the ongoing changes in the market. So before we dive in, to anyone who is new here with us today, welcome. Let me take a little second to introduce the driving force behind this endeavor, Astor Realty Capital. Under the leadership of Joe Burko, we have risen to the prominence of a current participator in a phenomenal $2.7 billion, real estate portfolio. We span across 12 major US markets, and we truly have redefined the industry standard with our consistent track record of delivering exceptional results. And we have produced an impressive 21% annual return to our investors over the last 7 years, which is well above the industry average. So tonight we have the pleasure of Andrew Milbank. Andrew is our CIO. He will be hosting this session. Andrew has been instrumental in shaping our investment and strategies, ensuring that we continue to deliver strong, consistent returns to our investors. His deep market expertise is critical to how Astor identifies some of the best opportunities in the market. And we also have our longtime senior analyst, Alex Mulcree, who is hosting with us today. So without further ado, please join me and welcome Andrew and Alex. And I will be passing it over to you both.
Perfect. Thank you, Laura. Good afternoon, everyone. Good evening. Appreciate you joining us. As Laura said, obviously we're thinking about, the investors that we have in, the Southeast. So we'll be mindful of that. Try to keep this brief for those of you that are joining from there, and obviously everyone is in our thoughts there as well. So just to recap a little bit of what Laura said. Right, we've invested at this point as Astor via both equity and debt in over 3,000 units, about 4 million square feet, no principal lost to date, and an average gross return of about 23.5% blended across the portfolio. You'll see here, and I'll touch on in a moment, a good concentration in New York and Florida, touching on a couple other major markets, Texas, Arizona, Chicago, Columbus, Ohio, right? Areas that we know well, that we've been to multiple times, that we live in, right? Because that's where we have a comfort level of understanding the opportunities. Okay, so a big part of our asset management capabilities, right? Being able to visit the assets on a moment's notice, and also just fully understanding as we're underwriting and reviewing new opportunities. Okay, what's going on in that specific market, in that specific sub-market, sometimes even block by block in real estate. And we'll touch on that a little bit here with, the 3 projects that we're going to go through today, why we felt that they were good projects, how they're performing, and how some of the, location characteristics have helped those projects. Okay, so just a little bit, I know that was a little bit tough to read. This is just a summary. a good portion being in New York, Florida. Many exits at this point. The 24 that you see there in New York were exited, about 11 of them. About 125 million of assets under management, mark to market that, right? What does mark to market means? It means what does the future value of that money look like? Just over 215 million mark to market assets under management. As I said, about 3,000 units. Okay. Another little graph here. One of the things that I personally always look at, and you hear it kind of beat to death, right? The risk-adjusted return. So over our entire portfolio, like I said, 23.5% gross return over limited partner equity, preferred equity, mezzanine debt, and senior loans. You'll see down there at the bottom, REITs, right? Residential REITs have delivered about 12.7% annually over the past, 25 something years, almost 30 years at this point, right? So we're outperforming REITs. I think one of the things to look at too, right, is, you as an investor, whether you have $100,000, $1 million, $10 million, right? You're making a decision, where do I invest my money? What are the universe of investments available to me? Right? And you're trying to hopefully do some amount of diversification, looking at the risk level. That's one of the benefits of real estate, right? It's a physical asset. There's a lot of positives about real estate. And I think we here at Astor have a very good, keen eye for looking at the potential risk of any investment versus the potential return of that investment, right? And making the right selections. And that really, like I mentioned before, comes down to being well located, but also partnering with the right developers, right? And looking at those investments. So I will turn it over briefly to Alex here. Alex can talk a little bit about the market and some of the way Astor's looking at the market, and we'll go from there, Alex. You're muted.
Yep, I was muted. I didn't realize. Thanks, Andrew. Yeah, as he said, that I will talk about the interest rate environment at the moment. I think many of us have anticipated a drop in interest rate for quite a while now, while the inflation has been hovering around 2.5 to 3% for a very long time, and it seems to be very sticky at that point. So finally, September 18th last month, the Jerome Powell actually reduced the rate by about 50 basis points. So while we had all anticipated multiple rate drops at this point, finally it was cut by 50%, by 50 basis points. And actually, what's interesting, last Friday there was a report from the Labor Department that there were 254,000 jobs that were added, which is far more than what was expected. So unemployment actually declined to 4.1%. And that's interesting because for inflation to drop, there needs to be a little bit more pain in the market. So, a hot employment market is actually quite the opposite of what the Fed wanted at this point. And the Reuters actually also reported that the Treasury yields on the 10-year note, they actually topped 4%. So it had a little bit of the opposite effect of what they wanted. Even CNBC also said that David Rush, who's the founder of Quantum Strategy, he said that the jumbo interest rates cut looked silly, populist, and panicky. So where do we stand here? Odds of another 50 basis point cut currently stand at 0% for the next meeting, whereas 1 week ago that was 35%. I read a report today that they anticipate slower rate cutting or rate cuts at 25 basis points. So another 50 basis point cut, which would be very big, currently is not anticipated. We're expecting smaller increments of rate cutting at this point to not overheat the markets at this point. Next, I think I don't have slide control, or yes, I do, I think. Next, one back. As we all do agree, though, that the interest rates on the long term will decrease, I wanted to show you what that could look like for Astor's portfolio, and I selected two properties here where I think it would be helpful if the interest rates do drop. For Arlington, Texas, which is right in the middle of Dallas-Fort Worth, We have a multifamily project here that a few of you may be familiar with. Current debt service would decrease if rates drop, which would help us a lot. We have a refinance scheduled for next April, so that could mean that we can prolong the life of the project a little bit longer for values for this type of asset class to stabilize. And on top of that, we may be able to have higher proceeds of that refinance. The project that we will also talk about later on in this presentation is in New York City. It's a condo building. And what we anticipate here, we have three more condos to sell. We would anticipate the buyer's appetite for higher priced condos in the 3 million plus range to be higher once interest rates do go down, as it is, a big difference between paying 6.5% and maybe 5% or even less than that. So it would be beneficial for both projects in this instance here. We also have a retail portion that once it's occupied, we could refinance that and eventually pay out some profits or principal. So what has Astor been doing over the last few months? Since June, we've been fairly busy with 3 different projects. One of them, or maybe all of them, you know of. One of them is in the greater Miami area. What we focused on here was the market in Miami getting more and more expensive and unaffordable for a lot of people from Miami. Thus, they have to move to the outer skirts of Miami, and that's exactly where we find opportunities with an exceptional developer that we've been trying to do business with for a long time. We've invested $4.5 million here, and we expect a return of 24%. And again, we're trying to capture the market of people that find Miami too expensive and they're searching affordable luxury outside of it. We have 2 projects in Brooklyn. One of them already invested. The other one is fully funded, but we're closing actually at the end of the month. 2 projects in Brooklyn, not far away from each other. It's the same developer that we're very happy with working with. And the reasons for investing here was the historic low vacancy across New York City, and the fact that this is a city program with about 80,000 people being registered in that city program. So about 1% of all of New York is trying to find housing, and the vacancy is 1.4%. On top of that, we have a very, very experienced developer with a net worth of about $300 million. And another reason for investing in these 2 projects, and potentially a third one, is that we see an opportunity to capture the high interest rate environment that we're currently still in by charging high interest rate preferred equity. So while our returns are capped, we do enjoy downside protection in these projects. So now moving on to, I guess, the future pipeline, I give it back to Andrew.
Beautiful. Thank you, Alex. Yeah, so actually, both of these projects I'm about to go over very briefly here with the same sponsors that we've closed with on the past 3 deals that Alex just mentioned. Again, the thesis here is greater Miami area, institutional Class A rental units that have a relative affordability, right? So, it may not be affordable for, the Dallas-Fort Worth area, but for Miami, for the Miami area, you're getting a pretty decent discount to living in Miami or Brickell or Fort Lauderdale, right? But you're getting a Class A building, beautifully designed, great amenities. So, Astor's very interested in this project. We're negotiating with the developer right now and in the preliminary stages of a capital raise here for up to $20 million. Very similar project to the one that Alex had mentioned prior here, the project on the left, right? Same developer, very similar project, right? This is their bread and butter. They've done, I think $4 billion worth of this real estate in South Florida, right? Another project in downtown Brooklyn, a very strong area there, 117 unit ground up rental project where we would be looking at a preferred equity position. Again, we are in the middle of negotiating here, so the numbers here are not final, but we'd probably be looking in at 16 to 18% net IRR to investors. And this would be, both of these projects would be, Q1 of 2025. And again, what we're looking at here, historic low vacancy, uh, great demand for rental projects in Brooklyn, and being able to capture that disconnect between where the market is, where the other equity providers are, and where you have strong developers with good projects, and they need equity. So we're able to get a very strong return for a very good project that a year or two ago might have been a much lower return. So this is as Joe said multiple times, a moment in time where we're able to capture very good real estate here with extremely strong sponsors and well located projects. I encourage anyone, if you have any questions, drop them in the Q&A, drop them in the chat. Otherwise, we will move on. Alex will start talking through our first project in Brooklyn as well, in the Boerum Hill area of Brooklyn. And Alex, take it away.
Before
Thank
we
you.
before we move on, guys, we actually do have a question just on the market conditions that maybe you can answer, Andrew. We've got a question from Mark Sorota asking if we have any thoughts about the future of Florida for real estate investment in terms of whether it will be affected by increasing weather events.
Yeah, it's a very, very timely question. I can say that, in terms of the Gulf Coast of Florida, that is not really an area that we have spent a ton of time looking at new projects. One of the reasons is weather related. I think one of the other reasons that, has been very important to us, and what I mentioned before, the relative affordability of the projects that we're looking at in the greater Miami area. You go to the Gulf Coast of Florida, you look in the, Fort Myers areas, areas like that. They have a greater susceptibility to weather events, but where the rents need to be for those projects to pencil, meaning the monthly rent that a tenant has to pay in order for the project's yield to cost to make sense, might be investable, that we know that we're going to have a good return from the project, is starting to become, or it has become unattractive, right? So it used to be, okay, I'm gonna go to Fort Myers, I'm gonna go to Tampa, I'm gonna go to those areas, and my rent is gonna be $1,500 a month, right? Pick a number, and that's more affordable than other areas, Miami, that's maybe $3,000 or $4,000 a month, right? Now those projects are $2,500 a month, $3,000 a month, where the value driver of moving to those areas isn't really there anymore. So you have to question, okay, despite, yes, people are still migrating to Florida, we are starting to see a shift that's really more in that South Florida area still at this point, as opposed to more of the Gulf Coast of Florida, because they've lost a little bit, I think, of that value edge that they had, right? And that's what we've seen in Texas as well, right? We have our project in Arlington, where rents are still very affordable for tenants, $1,200 a month, $1,500 a month. And what you've seen in markets like Austin and Houston, right, San Antonio to an extent, is a lot of newer projects coming online. That rent now is $1,800 a month, $2,000, $2,500 a month, right? May not seem like a ton of money, but for a specific tenant, that's a good chunk of money. $500 a month, $1,000 a month is a big jump for them to have to make to live in a newer project, right? So I think that's honestly been one of the more key areas. But it does bear in mind, monitoring that. And I think the positive, right, of being in new development is that the buildings that we're investing in are designed more and are much more thoughtful of, the potentially changing climate here. And they're just built a bit differently than assets in the past have been built, right? There's a lot of building done in Florida in, I think what the 60s and 70s, a lot in the early 2000s, and the design, was not necessarily built for that. So, and I do see, Susan, I see, that's part of what I was referencing, right? South Florida still has insulated itself a bit from the, slowing migration that other parts of Florida have seen, but certainly something we'll be keeping an eye on.
Beautiful. Thank you so much, Andrew, for that detailed answer. So Alex, we'll pass it back over to you.
Okay, thank you. The first project here that we will be discussing is our Borum Hill project. Very nice location right by the Barclays Center, and very close by to our other project that we've already exited with this same developer, on Mark Place. So literally just a block or two away from our previous project. We're building 105 units here. Total project costs about $160 million. We anticipate the timeline here to be 4.5 years, and the stabilized value of that to be $264 million. If we look at the update, we invested in the end of 2021. We are quite advanced here. Basically, all of the windows have been installed. We have, the facade is almost complete. Water and sewer have been completed, and the MEP has been completed until the 6th floor. The last floor now is being worked on. We're targeting TCO here for the first quarter of 2025. So you can see here, there's still work to do, but we're advancing at a really quick speed. If we look at here a budget comparison between what we've originally underwrote versus now, and what we've essentially how the project is performing, you can see the project costs increased by about $7 million. About 5% of the total project cost, which is somewhat normal for projects this size. 5%, it's pretty acceptable. On the other hand, though, we're performing much stronger than our initial underwriting. So we have a good chunk of pre-sales, and right now we're averaging over $1,800 per square foot, which is more than 20% than what we've originally underwrote. So while the project cost increased by $7 million, we have $45 million more in proceeds that we can project at the moment. And if you look at the Astor return down here, we've initially projected 75% as an overall return, or 18.6 on a yearly basis. Because those pre-sales are so strong, we're now projecting just under 24% on an annual basis. And what's nice also is because of that extended timeline, the multiple benefits from that too. So we're projecting now an overall return of almost 7%. Let's talk a little bit about the pre-sales. As of September, the pre-sales were 20 units, contract signed, which are about $38 million. And we had about, if you look at the bottom left corner, we had about 8 additional units in contract negotiation, which would bring the net pre-sales to almost $50 million. I spoke with a developer today, and we're still waiting on that Excel, but it looks like we're at 34 contracts signed. So this project here is performing really well. We're very happy. Again, it's a project that we've done now. It's the second project with that same developer, right around the corner of our first project. And yeah, that's pretty much it about this project here. So I'll hand it back to Andrew for the Upper West Side project.
Yes. So as Laura said at the beginning, right, we like to be transparent. This is one that's been a bit frustrating for us. We Upper West Side of Manhattan, 2505 Broadway, 44 residential units, as well as ground floor retail. This is one that, could say we got hit by COVID a bit, right? We invested in this at the end of 2019, in December of 2019. And, 3 months later, we kind of got hit with COVID, right? So we had pretty, substantial delays at the beginning of the project with construction, right? Delays delivery of materials. We also saw, a good bit of a cost increase as, cost really across the board and all real estate went up. We were affected by that. So that was kind of the, what hit us a bit there at the beginning of the project. After that, interest rates going up a bit, right, affected the sales of the units, right? These are averaging, 2 to 3 million for most of them, and then some larger units. That's still an area where you're going to see an effect of interest rates, right? This is a family area. There's a lot of good schools in the area. So these are, wealthy families, 2 or 3 kids, even at $2, $3 million, right? That's a sizable mortgage that you need to get financed. So definitely some issues there. On the other hand, as I mentioned earlier, right, very well located, strong developer, right, able to navigate all of these hurdles and bring the project to completion. It's beautifully designed, looks great. We have as of today just 3 apartments left, and the retail units. There's 2 of them separated on the ground floor. They can be connected in the back. We are in the final stages of negotiation on a 10-year lease with a tutoring company that would combine the units. So, there is a light at the end of the tunnel here. We expect to be exiting this project very soon and able to preserve our capital. But, not every project is an absolute home run, but, where we see that risk-adjusted return, right? Well located, strong development partner, good real estate with a good thesis, a good reason to invest here. You have families that want to be in this area for the schools and because of everything amenity-wise that the Upper West Side of Manhattan offers. So that was able to insulate us and get us over those hurdles that we faced from COVID, from cost overruns and delays, things like that. So while we're very happy with the building and being able to navigate those hurdles, it's certainly frustrating from a returns perspective that we weren't able to knock this one out of the park. So Alex, I'll hand it back to you. Talk about our project in Miami.
Okay, thanks. So yeah, this is our project in Bay Harbor Islands. Maybe you remember some of the other projects we have with this developer in Gravesend and Red Hook. So this is a developer that we've worked with a few times in the past, and that we're very happy with the quality that they're building. Here we're building actually a very similar product to the target audience that we're building for in Brooklyn in Gravesend. We're building 18 units here, larger sized units in a very affluent and underserved community in Miami. It's for those that don't know, Bay Harbor Islands is at the northern tip of Miami Beach, and together with Bal Harbor, it's a very affluent area, and there's a lack of I guess the luxury segment for condos. This is a very new project, so there's not all that much. Construction has not commenced yet, but we do have some updates to share that we're also very happy about. For instance, we have to date spent about $1.5 million. There's about $800,000 in soft costs that are still remaining. So far, we're on budget. We have the construction documents almost all bought out on the trades, and we've engaged our brokerage team, Inside Network. We're finalizing marketing materials and preparing the condo book for pre-sales. And on the pre-sales front, while we don't have pre-sales for this project yet, our developing partner has another project just a block away from here. And they're building a very similar project to this one. Slightly smaller units, but they've sold 5 out of 9 units, and they're averaging $1,200 per square foot. And the good news is also here that they've sold the larger units. They sold 3 2-bedrooms, 2 3-bedrooms, and they have strong interest in the penthouse currently. For reference, our underwriting for this project was $1,000 per square foot. So seeing the other building pre-selling at $1,200 on average for the larger units is actually a very positive sign. And then just towards the end, we have a few renderings here. The name of the building is Pool House. I'm not sure if you can see it here. The building actually has in the middle picture at the lower, in the second row, it has a lot of pools. That's why it's called Pool House. So yeah, I give it back to Andrew.
Okay. Yeah, so again, we appreciate everyone joining us. We tried to keep it a little bit more brief tonight, given the storm, and I know we have many investors from Florida, so appreciate everyone joining. We are, as always, available. Myself, Alex, Laura, Marika, Joe. Reach out if you want to schedule a call, talk about any of the, existing projects, future projects, talk about the market overall. We are here, we're available, and we try to be as transparent as we can. And we appreciate the trust that you all place in us.
Beautiful. Thank you so much, Andrew. Thank you, Alex. I personally think that was a great session. I second your words. We are always available. We started doing these sessions. We're having great turnout, but please do not hesitate to reach us at any time, to speak with Joe, to speak with our wonderful team here. We are here for you. So wishing everybody a blessed rest of your day, and we will speak soon. Thank you all.
Thank you, everybody.
Thank you. Bye.
You work hard for your money. It's time to make your money work just as hard for you.
You will have a secure future if you were to use Astor.
Hi, my name is Raquel El Khadif, and I'm a realtor with Broker Nation Real Estate in South Florida.
Hi, my name is Elena. I'm originally from New York, now currently living in Miami.
First and foremost, I was looking for my investors for institutional level investment. And the beauty of Astor is that an investor can come in with relatively a small amount of money and still be part of a big project with high returns.
Over the years, I've had many experiences with investing. I've learned so much, and approximately 5 years ago, I ran into a company, Astor, and found that they completed my investment approach. They are so selective with their projects.
The returns that they project are always high, but the track record is even higher than that. So it's kind of an element of under-promising and over-delivering, which I liked, of course.
Just based on years of trial and error and other companies that I've invested with, that they are far superior to all the other options that I've tried.
And it gives me and the investors some peace of mind.
I like that with Astor, I can sit back and have my money working for me.
They attract seasoned developers.
Feel very safe and secure with my investments with them.
I fell in love with them.
And I only use them now for my investments.
You guys made us feel like we're part of the family, and I thank you for that.